Welcome everyone to the very first Trade Finance Global Spotlight On webinar series. This is Spotlight On Carbon Credits. My name is Charles Osborne. I'm a director here at TFG, and I'm delighted to be joined by Bethanie Castelnuovo, CFO at SCB Group. We've got Alexis Christodoulou, Global Head of Trade and Sustainable Commodity Finance, Societe Generale. Julie Noller, Carbon Trader at Societe Trading. And last but not least, we've got Aaron Brody, Pricing Director at Generale. Welcome, everybody. Thanks very much for joining the very first edition of this. Perhaps we could maybe start by just having a very brief introduction. Bethanie, if we could kindly start with you.
Thanks, Charlie. Hi, so I'm CFO and Director of SCB Environmental Markets. We are active in low carbon commodities, voluntary carbon credit markets, and we also have a full service sustainability advisory team.
Alexis?
Sure. Hello, everybody. My name is Alexis Christodoulou, and I'm heading the Trade and Sustainable Commodity Finance at Societe Generale. We are particularly, I would say, focused on the sustainable aspect of our business as well. And this is why also we are very focused on the carbon certificates, and this is something we're going to discuss a bit more in length going on.
Hi, I'm Julie Noller from Societe Trading. I am leading the carbon trading capability here, both in compliance markets and in voluntary carbon markets. And this also involves development of carbon projects in Azerbaijan.
Hi, Aaron Brody, Pricing Director at Generale. We're a data-led index provider focused on bringing transparency and consistency to the voluntary carbon market.
Right, thank you very much. So the carbon credits market is one I started learning more about around sort of 2018. And I have to admit, I was more than a little bit skeptical. Obviously, there's been a lot of question marks over the verification process, the validity of the market. But I believe we've come a long way in the last few years. The introduction into Article 6 of the Paris Agreement has seen a boost to the market by incorporating a framework that allows countries to meet climate targets through a central carbon market. Even here in the UK, the government has also backed climate leadership with the aim of becoming a green finance capital. So there have been some real positive movements here. And this panel of experts that have kindly joined us here today will not only provide a detailed update of the market, but also a little bit of much needed education. Perhaps a good way to start really is kind of addressing the differences between compliance and voluntary. Aaron and Alexis, perhaps if I could go to you guys first. Aaron, if you could give maybe a bit of an overview of the voluntary market, please.
Yeah, of course. And I think, as you say, it's good to set the scene for the last few years. When you look at the voluntary market, it's no one's surprised to hear that the demand's been struggling recently over the last couple of years. You have the secondary market, which is where you have the sort of brokered side of the market, and you also have primary, which is more direct offtakes. And I think the last few years we've started to see a drift towards more direct offtakes. We also have avoidance and removal. I think if you look back, you would see a large majority of credits coming into the market and also being traded and retired are in the avoidance space. But in the interest of quality, people are starting to move towards the removal side of the market. The discussion around quality is something that's been pretty major. And because of this, we've seen the introduction of schemes such as CCP by the ICVCM, I should say core carbon principles by the ICVCM. And we've also seen the introduction of quality ratings companies into this space. So you have the likes of B0 as well. As we've drifted further down that line, we sort of see a almost pseudo compliance space opening up with your schemes such as CORSIA. So we have CORSIA phase 1 now, and you also have the introduction of Article 6. And you have countries such as Singapore allowing Article 6 compliant credits into their tax obligations. And you also have the European Commission currently considering allowing international carbon credits to go towards the EU's 2040 climate goals. I think there may be some differing opinions on whether that is a good idea or not, but I'll leave that for later on in the discussion. I think on that note, probably good to head over to Alexis for the compliance side.
Sure, thank you very much. Well, the compliance aspect of the carbon certificates is, I would say, much simpler because it's by law that the companies that do pollute must compensate such pollution by acquiring or purchasing those compliance certificates. And therefore, there is a government, I would say, action, or at least the European Union or in the US, or depending on the region. But it is a state, I would say, driven requirement by law. And therefore, the idea behind that is that the government tries to push those polluting or emission companies to improve things slowly but surely, and up until 2050 that they try to greenify their industrial assets. We see that very often within the utilities companies, where in order to produce, for instance, power, we need to pollute. I'll put that into brackets. Therefore, we need to somehow to compensate by acquiring those compliance certificates. And the idea behind that is those compliance certificates, the governments get some means in order to invest in more green energy investments. So maybe very briefly, those compliance certificates have to be provided by the given company or the industry within a given time frame. More essentially, it comes through, it's on an annual basis. And this is something that they have also to declare and report as an obligation from the industry or the government bodies.
Thank you, Alexis. Thank you, Aaron, for that very detailed overview. So essentially, here we are. The world has demanded a carbon market. We're in it now. So how do we scale this up? Bethanie, perhaps I could go to you for this.
Sure. So I think we just really need to drive corporate demand. And as you said, the world has collectively decided that carbon markets are absolutely essential as we move from high emitting fossil fuels to a zero carbon solution. We already have 105 countries that have submitted a designated national authority to manage the global carbon market locally, which I think signals really a growing readiness among countries to engage with carbon markets. Voluntary carbon markets really have the potential to provide financial support to least developed countries. If we think of other mechanisms like carbon taxes, such as CBAM, they're not seen to align with the common but differentiated responsibilities under the Paris Agreement. These LDCs, they don't have the capacity to create their own carbon taxes locally, so they're penalized by things like carbon taxes. But unfortunately, I think despite really strong international support and the potential of voluntary carbon markets, a lot of companies, unfortunately, still perceive the risk of doing the wrong thing as outweighing the risk of doing nothing. So I think that Article 6.4 will go some way in bridging this gap, because what it's going to do is it's going to give corporate buyers the ability to ensure that their actions are supporting and enhancing global initiatives. I think that when you look at the data, it shows that companies that are buying carbon credits are decarbonizing at twice the rate of those that don't. So I think that carbon credits really are serving as a bridge to deeper transformations within these corporates.
Thank you, Bethanie. That's very interesting, and also sort of touching upon some of the regulations that are key to kind of drive this forward as well. Julie, going on to you as well, I'd love to get your take on this, and perhaps also kind of looking at what's previously stopped entities from entering this market.
Yes, Charles, thanks for the question. It's very important because we are actually seeing the fact that with the Paris Agreement, and it's taken 10 years to get to this Paris Agreement, because it was first announced in 2015 and it was finalized in Baku in November last year. And we are in that operational phase. We are still building this market. But I think the key thing is that it's a globally agreed market. It's going to address some of the issues that we saw in the previous Kyoto Protocol, which was under the Clean Development Mechanism, which were things like double counting. Now we're going to move towards a global registry of these carbon projects, which allows everyone to start to get to a point of more comfort that this is contributing, as Bethanie said, contributing to actual reduction in emissions, and also the fact that these will be related to nationally determined contributions from each country. So, for example, corporations coming into this market now can do it without having to actually request this corresponding adjustment, because they can still contribute to a nationally determined a country's nationally determined contribution. But historically, banks and financial institutions have really struggled with non-regulatory markets. So without a clear demand signal, without a clear, mechanism for them to sort of, should we say, ensure revenues from carbon projects, they've been a bit reluctant to come into this space. They've always been very active in the compliance and regulatory markets in terms of helping financing these. But what we really need to see is these institutions and banks, for example, to come into this compliance market. I think the Paris Agreement will help them do that. In addition, it's not just, for example, at SOCAR, we are already seeing banks happy to provide trade finance facilities at good interest rates to help finance our activity in carbon credits. But in terms of actually getting involved in carbon credit projects and the primary development of projects is where we really need to see the next step. And I think the Paris Agreement will give that to these institutional investors and banks. Because you have to remember, as also has been previously mentioned, a lot of these carbon credit projects are being in developing countries, and these jurisdictions, a lot of banks, a lot of financial institutions have a lot of due diligence to do it, or also to get comfortable with this. Whereas if it's under the umbrella and the governing body of the UNFCCC and the Paris Agreement carbon crediting mechanism, then I believe we will see more support from these important players in this market.
Great, thank you, Bethanie. That's a very comprehensive viewpoint as well, and I think it's quite a nice segue talking about the bank's appetite in terms of providing trade finance facilities as well. So I think that's quite a nice kind of move towards asking how we increase investment. Obviously, that's one integral way of kind of still building that market. Alexis, I'd love to get your thoughts on this. I know we've spoken privately about this, and I'd love you to kind of maybe give an overview of what Societe are doing in the market as well.
Sure. Maybe we definitely need to do again once more the distinction between the compliance certificates and the voluntary, I would say, schemes. I'll start with the natural-based solutions first. This is indeed, as Julie rightly pointed out, we needed to have the framework. So the framework seems to be there now. We as banks, we need to address also the reputational risk. That is very important for us. It has always been very important within Societe Generale. For instance, we have been reviewing a lot of deals, but not all of them would meet our own criteria. So we see that there's a strong interest into the market. For instance, in Q1 2025, there is another 5 billion in capital announced for the voluntary carbon markets. So we track those figures. We see that the market is growing on a steady manner, and this is very important overall. We see also that there are a lot of retirements in terms of credit volumes, about 30 million of credit volumes in Q1 again this year. So again, figures speak by themselves. So on that part, I would say the bank has set up a fund to support the emerging leaders, of which that fund is 1 billion euros, and that part of that fund is allocated to the natural-based solutions. So the bank has put the means, and this is something we're targeting in the coming weeks and months to further develop and support our clients in that regards. I would like also to say a few words on the compliance certificates side, because this is something that we have working for some time as well, because the framework was already there and much easier for us in terms of structures. We have already started doing some deals around the world, and the idea for us is to further enhance that growth and support our clients. For instance, we are currently working on a new product, which is we as a bank, we've seen that there's a strong interest from green investors, but they could not have access to the deals. So what we have decided as a bank is to work closely with the investors, the green investors, as well as our clients. Clients can be corporates, funds, utilities, any type of client, and in full transparency. So the idea is how we combine that willingness from green investors to invest into that sector and the need for compliance certificates, at least, from our clients. And we are combining the two of them by providing a given structure where it would allow the green investor to invest into a vehicle, and that vehicle will do the purchase and keep the carbon certificates, the compliance ones, for our clients for a given time frame, the one that they would need from their end in order to comply with the regulations. So indeed, there is a lot to be done. We as a bank have the DNA in that sector, and we want to be leading those efforts for the industry. That's for sure.
Fantastic. Thank you, Alexis. I know we spoke about this privately, and it's fantastically interesting to hear about the kind of how you're incentivizing new investors, new investment into this. I think with any market, really, they need a lot more outside investment to kind of come in, including the CTF market in general. So I think this is a very interesting project that you guys are embarking on. So thank you very much for providing some information on that. Moving away kind of onto the pricing side of things. Aaron, what pricing developments are expected in this market over the next few years?
Yeah, I think a lot of, I'm going to start to get sick of saying the word, but a lot of it comes down to demand. What we've seen in the past, especially if we look into the secondary market, the dwindling demand has really led to a sort of steady falling pricing. Some of the higher quality credits and some specific technologies have fared better. And I think what we're starting to see is a sort of rise in a minimum viable standard that people are willing to buy. If you look at sort of buyers demanding B0 rated projects, over 3/4 of the demand is in BBB or higher. And as this sort of develops, we'll start to see a shrinking of the supply pool in the sense of what is actually viable. And this should, one would expect, lead to prices rising. I think what you also see is a change in the types of projects people are buying, as it's moving from avoidance to removal. So you look at sort of the portfolios of buyers, and there's definitely a greater percentage now moving towards removals, and this will again push up the price of those portfolios overall. Looking more on the supply side, we see sort of a increased regulation and also the desire for higher quality, leading to a sort of smaller level of issuances within the market. So we're sort of starting to move into an era now of, for the first time, of net negative issuance. It's not to say that there's still not a massive lack of lack of demand in comparison to where the supply is currently, but it's a sign of things to come, and it's the direction. It shows the direction in which the market's moving. And as we see net issuance fall more and more negative, then you again would obviously expect to see that price to rise.
Thank you, Aaron. I don't know if anyone else on the panel has any viewpoints of where pricing developments might go to.
I could actually jump in with one further point. Sorry, I was just sort of. I think it's worth saying that what I sort of speak about there was, of course, the secondary market. I think what we're also seeing is a lot of movement towards the primary market, a lot of early stage investment, which is only it is more in the projects that you can't necessarily get on the secondary market. If you're looking at direct air capture, for example, and the disparity between pricing between, let's say, a Chinese wind project and direct air capture, they're almost incomparable, right? And as investment moves into that primary market, goes into the early stage development of these new technologies, we will, on the higher end of things, see an improved efficiency and see that sort of price at the top end actually begin to fall, but all in the name of improving the quality and efficiency of those projects.
Yeah, I would also like to add that obviously just for clarity for listeners is the fact that a lot of people quote a lot of the time that the EUTS is trading at like 75 euros a ton, and you hear about carbon credit projects trading, $5 or even below. It's as we see with the Paris Agreement, that more and more compliance markets use this market as their additive, like they allow a certain percentage to use from Article 6 credits. Then we can see much more of a convergence in some of these prices. But obviously, the right types of projects need to be directed to the right types of compliance markets, and that's key. And that's why the EU, for example, is focusing on potential removal credits that are priced higher because they cost more to implement. And this is super important for anybody, in this market to understand. But all carbon credits have their, benefits, and they're contributing to reducing emissions, and they have their place in various different markets. And so you might see different compliance markets trading at different levels, and they will attract different types of carbon credit projects.
Yeah, maybe if I can add on that specific point, and this is something we see, I would say, from our clients as well. There are clients who might be willing to invest in a given geographical area or a given type of project. So the price would depend as well from the demand side, because specifically in some occasions, they want definitely to have clients who want to invest, or investors, pure it can be funds. They definitely want to avoid any reputational risk. So they are ready to pay an extra premium if needed, to get the best asset in that sector. So we're going to have a range of different prices, that's for sure. Now it is more as to what the investor would like to have in terms of product, and what is the price he's ready to pay for it.
Right, thank you all. Just moving on to something I mentioned in my kind of my opening blurb, talking a little bit about transparency verification. What changes have happened in regards to that, and can AI implementation help facilitate transparency in any way? Bethanie, if you could lend some words on this.
I think I'd just like to start with the fact that I think that registries like Gold Standard and Vera are doing really excellent work on relatively small budgets. I think this level of transparency hasn't really been seen before. I mean, you can look at every project, you can look at all the documentation, you can see what's been issued, you can see what's been retired. This isn't something you can do with any commodity. Take crude oil, for example, that has a history of, fraud, bribery, sanction busting. I mean, this level of transparency that we have in voluntary carbon markets is really phenomenal. But that being said, I don't think that manual tools can process, the volume, complexity, and the variety of the environmental data that is now available. And I think the result of that is that high quality projects are often undervalued, and low integrity credits are able to kind of pass through unchallenged. So I think this is really where AI comes into play. Now we have really an opportunity to revolutionize how we evaluate projects. We've incubated a tool called Carbon AI ourselves, and it has all of the project documentation, for example, for all of the registries, and you can very quickly create your own due diligence report on any project that you're interested in looking at very quickly. So I think that LLMs can really parse and understand vast amounts of unstructured project documentation. They can uncover inconsistencies. You can much easily extract insights across thousands of projects, really with superb accuracy and speed. So I think that for sure, artificial intelligence is a game changer for voluntary carbon markets. Also in terms of project ratings. So right now there are different project raters out there. They're doing things quite manually. The methodology isn't always that clear. But now with AI, you can really, automate project ratings across 1 million data points and do that very consistently for a high volume of projects.
Thank you very much. Does anyone else have any words on this at all?
I think the actual, as Bethany mentioned, the actual complexity of verification of some of these projects, especially when you're talking about vast amounts of land with forest coverage, for example, AI and satellite imagery, for example, is going to help massively, aid this process and make it more accurate as that develops as well. So the actual verifiers will be able to use much more detailed data rather than just sampling, for example. And I think this will only escalate and improve over time. So that will be give people also much more transparency and more comfort in the level of the verification of these projects.
Thank you. Some very good points there about how to kind of make people a little bit more comfortable, perhaps, with verification techniques and methods. How far are we away from perhaps a little bit more standardization? I think this has been talked about in sustainability for a long, long time. But how close are we, I guess? I think it would be remiss for us not to talk a little bit about the current political environment. I know it gets brought up in any subject, I guess, at the moment, but looking at that and perhaps some of the ESG backlash in the US currently, how has this affected the market, would you say?
I think that companies that are committed to the net zero goals are continuing to purchase and retire high quality carbon credits. But I do think it's dampened investment appetite. We've seen a rise in brownwashing, which is companies that are, trying to stay under the radar, and they're understating what they're doing in the ESG arena. If you look at the blank retirements, so that's retirements that are not attributed to any specific company in the registries, they've increased in Q1 2025 from 19% to 28%. So you really see, getting back to companies are more afraid of doing the wrong thing than doing nothing. So unfortunately, I think this has had an impact on carbon markets because credit developers, investors, corporate buyers, they rely on a stable policy environment to justify these long-term expenditures in emission reductions. And there has been a decline in issuances in Q1 2025. There was a 20 versus Q1 2024. There was a 22% decline. And I think that if we don't increase the investment in developers, and that could be through direct investments or corporate offtake agreements, then we're absolutely going to be facing a shortage of high quality projects as we approach our 2030 objectives.
Thank you, Bethany. That's very interesting, and I love the term brown washing. I actually heard it described in a different way. People called it green hushing, which I thought was quite interesting. Yeah, it came up on a panel on energy transition, and I think you're completely correct. The mood is slightly dampened. We've got the phrases such as "drill, baby, drill," and it's kind of, from what people say, the work's still getting done. The projects are still getting done, but no one's shouting about it anymore. The PR from it is less impactful. Does anyone else, before we move on, have any slight thoughts about political landscapes, whether it's not just the US, but anywhere kind of all over the world?
Yes, maybe if I can add on that, I don't think it's specific to the US, it's around the world. But we already knew that in that sector there will be ups and downs. So what for us is the most important is to keep the long-term vision and what we believe has to be done in order to support our clients, and also the willingness of I would say the industry to make things happen. And as of today, we might have globally a reduction of interest in the US. This is something that the bank itself has seen as well. However, we see more and more US corporates investing abroad or even in the US, but they don't publicize that too much. And the thing is that for sure there is an increasing demand. That's the globally the figures speak by themselves, and this is something we track again. And we believe that on the very long term there is maybe a different alternative, but that's the trend that we have to support as a financial institution. That's for sure.
I think sort of touching on the sort of long-term side, these goals are 2030, but then 2040, 2050, and even further, right? And the goals are can outlive any government in the US or the UK, and so it's worth keeping that in mind. And the people within the market that are aiming to get to these goals know this and are still working to keep the demand, keep the investment there, so that the long-term goals can be reached.
Exactly.
Yeah, I agree. The voluntary nature of the market means that it will be very cyclical. Only a few years ago, we saw people focusing on energy security during the energy crisis rather than carbon neutrality. This happened shortly after the last, or shall we say, boom, especially in market prices and demand for carbon credits. But so I think it will come back. But as you say, the landscape is not smooth. But with the Paris Agreement, I think we are seeing a very different type of demand come to market. And this is, driven by NDCs and the global climate goals, which I don't think are going to be able to stop. Again, they are longer term, but we are, seeing a market with definite demand coming. So I think we see a longer term positive trajectory.
Thank you all for those points. I think it's some very interesting discussion points in general made throughout this discussion. Perhaps a nice way to end is to give everybody kind of a last word. How do you see the market developing in the next 5 to 10 years, and any last comments perhaps on this that you'd like to make?
I think over the next 5 to 10 years, we're going to see a proliferation of compliance and quasi-compliance markets that are tied to the voluntary carbon market. And I think those lines are going to continue to blur. I
think that kind of goes hand in hand with what I would say around the increase in regulation will lead to these markets becoming more sort of pseudo compliance, and that will lead to higher quality, all in all.
I agree with Aaron and Bethanie. What we're going to see is more and more compliance markets within countries, but because they don't necessarily have an infrastructure to implement an ETS like the EU ETS, they will rely on the Paris Agreement as the basis for their markets, and this will continue to drive demand for carbon credit projects and the certificates.
I think everything has been said here, but we believe as well that the compliance market is the one that will further increase in the coming years. However, we believe as well that the natural-based solutions will be increasing. There will be a flight to quality, that's for sure. And eventually, what we believe is that there will be a conversion of the natural-based solution prices and the compliance certificates as well. And that would make sense, because at the very end, that's what an investor, that's what a client would be seeking. But of course, the difference would be made on the type of quality and also the geographical area, and depending also on the government decisions on the given country, or I would say geographical area.
Well, there you have it. Some excellent last points made. I think for the very first Spotlight On panel, I don't think I could have had a better array of experts to join me. So it just remains for me to thank every one of you. Thank you, Aaron. Thank you, Bethanie, Julie, and Alexis for joining us for the very first Trade Finance Global Spotlight On, but the first of many. So thank you, everyone, for listening, and please stay tuned for the next episode. Thank you.
Thank you.
Thank you.